Traders, imagine this. You don't need any fancy indicators on TradingView to spot the traps that can wipe out your profits. Let me show you how to identify and avoid these pitfalls, starting with the break of structure trap. This trap is a clever tactic employed by savvy investors to entice unsuspecting retail traders into the market at just the wrong time. It exploits the inexperience and emotional reactions of average traders, ultimately leaving them stuck as the market shifts against them. Imagine this: as retail traders notice the steady rise, their confidence grows, prompting them to seek opportunities to enter long positions. When the market surpasses a previous swing high, it's typically viewed as a bullish signal, suggesting that the uptrend will persist. This is precisely where the break of structure trap comes in. Smart money knows that many retail traders will perceive this breakout as a buying opportunity. They recognize that the average trader is conditioned to look for bullish signals and to enter the market when they appear. As a result, they orchestrate a false breakout. Once they've attracted enough retail buyers, they quickly reverse their strategy and start selling aggressively, pushing the price back down below the broken swing high. The retail traders who bought into the false breakout find themselves trapped, holding long positions in a market that has suddenly turned against them. As the price continues to decline, many of these trapped traders begin to agitate. So, they'll exit their positions, often at a loss, just to relieve their pain. And who's waiting to scoop up these positions at a discount? That's right, the smart money. They've secured their profits and are prepared to repeat the cycle. I'm sure you've experienced this frustration in many of your trades. Well, you're not alone. So, how can you avoid falling into the break of structure trap? When you notice the market breaking above a swing high, resist the urge to buy immediately. Instead, wait for confirmation. Check if the price can maintain its position above the breakout level. Look for increased volume and momentum to support the move. If the candles above the previous swing high lack volume, be patient and wait for a pullback. Don't follow the crowd blindly, think like a professional trader and always look for opportunities to buy at a discount. Now, let's talk about the change of character trap. This is just one more cunning strategy that smart money used to trick retail traders. It preys on the ignorant notion that a broken swing high or low indicates a reversal of the prior trend, with terrible results for those who fail to understand the true nature of the market. Here's how it works. 1. Imagine a market clearly in a downtrend, where sellers dominate and the path of least resistance is downward. However, smart money may choose to manipulate the market since they always aim to sell at a premium and require new buyers. With the downtrend being so apparent, few traders are inclined to buy, prompting smart money to start purchasing, which leads to a period of consolidation or a range. This creates the illusion that the downtrend is losing momentum. They then push the price above the upper boundary of the range, breaking a previous swing high, which is referred to as a change of character. Retail traders, thinking this break signals a bullish reversal, begin to buy in. They believe that the market's outlook has shifted from pessimistic to bullish, and they don't want to lose out on the projected increase. And this is precisely what the astute investors had been anticipating. As retail traders jump into the false breakout, smart money begins to sell aggressively, offloading their positions onto unsuspecting late traders. The price, unable to hold above the broken swing high, quickly declines. Therefore, retail traders are trapped in losing positions. Retail traders panic as the market resumes its downtrend, either selling at a loss or clinging to their positions in vain. Whereby, smart money, having sold at the peak, can now buy back at lower prices, capitalizing on the misfortune of the trapped traders. The takeaway? Don't automatically assume that a broken swing high indicates a change in market character. Always evaluate the broader context. If the overall trend is down, approach breakouts with caution. To avoid falling into the change of character trap, be wary of breakouts that go against the prevailing trend. Wait for confirmation, such as sustained buying pressure and increased volume, before entering a trade. Markets seldom reverse smoothly from bearish to bullish, and if the breakout is legitimate, there will be opportunities to enter after the price retraces. Let's talk about moving on to the pattern failure trap. This is perhaps the most common strategy employed by smart money to take advantage of the predictable reactions of retail traders to familiar chart patterns. It capitalizes on the belief that when certain patterns break, they will lead to significant moves in the anticipated direction. However, this belief can result in substantial losses for those who fail to see the manipulative tactics used by institutional traders. Let's take an example where the market is creating a triangular pattern and the price is bouncing between trend lines that are convergent. Recognizing this pattern, retail traders anticipate a significant move after the price breaks out of the triangle. Retail traders expect the decline to continue and start selling aggressively when the price falls below the triangle support level. When the price finally breaks below the triangle support level, retail traders start selling quickly because they think the decline will continue. They want to hedge against the anticipated decline because they think the pattern has justified a bearish outcome. However, this is exactly what astute investors have been waiting for. As retail traders sell into the break of support, smart money begins to buy heavily, absorbing all the selling pressure. They understand that the break of support has likely triggered new sell orders from retail traders, and they are eager to take the opposite side of these trades. After briefly dipping below the broken support level, the price suddenly reverses and starts to rise. Retail traders, now trapped in short positions, begin to panic as their anticipated downtrend fails to occur. As the price continues to rise, many of these trapped traders will be compelled to buy back their short positions at a loss, further contributing to the upward momentum. Having bought at a discount, the savvy investor can now sell at a premium, taking advantage of the disillusionment of the general public. The key takeaway: never assume that a broken pattern will always lead to the anticipated outcome. Smart money is fully aware of the common patterns that retail traders monitor, and they often use these patterns to their advantage. To avoid falling into the pattern failure trap, you need to think beyond the obvious. Don't just sell blindly on a break of support or buy on a break of resistance. Consider the broader context. Is the overall trend still complete? Is the volume supporting the breakout? By asking these questions, you can prevent yourself from getting caught on the wrong side of a failed pattern. Remember, the market isn't always logical or predictable. Smart money frequently seeks to exploit the assumptions of retail traders and has the resources to move the market in their favor. Patterns can and do fail, and those failures can be costly for those who are unprepared. Finally, let's discuss the wick rejection trap. The wick rejection trap is another clever tactic designed to exploit the inexperience and emotional vulnerabilities of retail traders. This trap capitalizes on the common belief that a rejection candle, particularly one with a large upper wick, indicates a trend reversal. Imagine a market that is clearly in an uptrend. At this point, a bearish rejection candle forms, characterized by a small body and a large upper wick. This pattern suggests that the price rose during the period but was strongly rejected, closing near its opening price. Retail traders, noticing this bearish rejection candle, interpret it as a signal that the uptrend is running out of steam and that a reversal is imminent. They believe that the large upper wick indicates significant selling pressure and that the market is about to decline. Acting on this belief, they start selling, expecting to profit from the anticipated downturn. However, contrary to the expectations of retail traders, the price does not reverse. Instead, it continues in the direction of the prevailing uptrend. The bearish rejection candle, despite its alarming appearance, turns out to be just a minor fluctuation in the ongoing upward movement. Retail traders who sold based on the rejection candle find themselves trapped in short positions as the market moves against them. As the price keeps rising, they incur increasing losses, and many will be forced to buy back their positions at higher prices, further driving up the trend. The main lesson here is to avoid trading against the primary trend based on a single candle formation. A rejection candle, no matter how significant it may appear, is not a dependable indicator of a trend reversal on its own. Smart money understands this and often uses these candles to their advantage. After the rejection candle forms, smart money will start buying, absorbing the selling pressure from retail traders. They know that many traders will see the candle as a reversal signal, and they are eager to take the opposite side of those trades. To avoid falling into this trap, you need to think beyond individual candle formations. Look for additional signs of strength or weakness and always check the volume. There are specific volume spread analysis, VSA, patterns that can either confirm or refute your bias. Keep in mind that a candle that appears to indicate a reversal may simply be a distraction within the larger trend. This concludes our video. Don't forget to subscribe, like, and share.